Welcome to CrushTheStreet.com's weekly market wrap-up. Let's get started in the equity sector, which saw another declining session following a tumultuous week that began with a horrific tragedy in Boston. Tax Day of 2013 will obviously have a heavy-hearted association with the bombing, but outside of those events, that fateful moment may also be remembered for the turning point of a radical paradigm shift in the financial markets. We know that the major indices took a big hit on Thursday, but none more so than the Nasdaq, which gave up 1.2% from the prior session. Even more alarming, Apple shares, once a darling of the equity bulls, are now below the $400 mark. This is in stark contrast to last year's sentiment, where we were inundated with talks about the electronics giant taking out the $1,000 barrier. Still, the mainstream financial media does deserve a modicum of credit for loyalty, with many analysts calling these price points as major buying opportunities. Is it? It's possible, but there are some points to consider. The fundamentals look great, and that is what analysts usually key in on, listing metrics such as earnings per share, profits to earnings, and PEG ratios to list but a few. But companies don't run on paper, they run on real profits and real growth. Too often investors place an undue emphasis on the financials, not realizing that the forecasted growth numbers used to calculate many of the metrics of the fundamental analyst toolbox are simply that, forecasts. If the forecasts are wrong, the decision to invest could be dead wrong, and that may be what we are experiencing with Apple. Even though they led the industry in groundbreaking technologies, the consumer electronics sector is extremely cutthroat, with total, unmitigated disaster just a small misstep away. Then there's a commodities sector. What the hell is wrong with commodities these days? One look at the news ticker and you'd think that the world was collapsing. First, you have West Texas Intermediate crude oil at $88 per barrel, right before we head into the busy driving season. Second, we see that Brent crude is in double-digit territory. Unreal. And then you have the precious metals, which has been a complete disaster. If we look at the technical chart for the silver ETF SLV, we note that the trading occurs in a reasonably consistent manner with very few gap days of substantial variance. 2 gap down days of over 5% each occurred in the month of September 2011 after the SLV failed to make new gains off of the April peak. About 100 million shares were dumped on that particular session, which eventually saw the ETF retest a $25 long-term support line. However, what occurred on Monday, April 15th was an absolute anomaly. The SLV gave up nearly 9% of valuation on the opening bell, yet the volume was half that of the September session. Worse, the trading pattern has been lethargic following that huge drop, prompting whether this is truly a buying opportunity or not. Ultimately, it depends on your mindset. If you believe that Keynesian policies can be sustained despite an absence of real growth, by all means stay with paper. Technically, the spike bottom could be signifying an overall reversal in monetary cyclical patterns, the same way that silver's spike top of 2011 signaled a return of a substantially stronger dollar. And that will do it for this edition. Thanks for watching, and we'll see you next week.
For more unconventional ideas, please visit CrushTheStreet.com.